interest rate differentials coming down will mechanically allow for more hedging ability.
So as the Federal Reserve is cutting interest rates, it's reducing the cost of foreign entities who live in low interest rates worlds, Japan, China, lots of Europe, to hedge their FX exposure to the dollar. This episode is brought to you by Fiscal.AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. I'm here with Jon Turek of JST Advisors, a global macro research firm centered on central banking and macro themes. Jon, it's good to see you. How are you thinking about the dollar right now?
This is kind of one of these phases where the tactics and the bigger picture kind of clashed a little bit. I think where I find myself is still terminally quite bearish to the dollar. I think, the beginning of this year, we entered something that I think is going to be a bit more structural in nature. I think the center point to me is that we started this year with the market basically asking for an impossible trifecta. The market wanted, from an FX perspective, it wanted high tariffs, it wanted high growth, and it wanted high rates. And the confluence of those factors on the back of the prospective Trump administration, led the market to entertain that sort of dynamic was possible. And that's why we came into the year with a dollar effective exchange rate being around a 40-year high. But that kind of confluence was sort of the backdrop. And I think what ended up, or what has happened, is a few things have transpired that have moved to the counter of that. And one is this trifecta really hasn't been able to hold. We've seen that growth, while it's hung in relative to sort of the adjustment in the effective tariff rate for the economy, it has weakened this year. We've seen rates come down for much of the year. The Fed has resumed its cutting cycle. And then, we've had this, I would say, the second derivative impact, where tariffs have sort of kicked off what I would say rebalancing mechanisms that were long overdue, but have been catalyzed by the Trump agenda. And I think most notably, we've seen a big switch in the German fiscal backdrop, with Germany announcing over $1 trillion in fiscal spend over the coming years. So, that sort of backdrop where the dollar was, came into this year, what I kind of deemed to be, unsustainable level, backed on things that I thought were incompatible. That sort of sets the tone for me in terms of where the dollar can go, not necessarily entertaining these big left tail concerns of what is gold suggesting, what is Bitcoin suggesting. I think there is a message in that, but I don't have this grand, I just think we've kind of entered a new regime in the dollar vis-a-vis the last, I would say, 3 years, where sort of the dollar's been the best incremental growth story, the highest rates, and the beneficiary of capital flows via having, a thematic equity story.
Later on, I will be asking you about what is gold indicating, what is Bitcoin indicating, as well as your longer term view on the dollar. You co-authored in 2022 a staff paper with the New York Fed called The Dollar's Imperial Circle. But just to put that on pause for a moment, Jon, going back to what you said about the dollar, you said going into the year, and I think you said the market wanted high tariffs, high growth, and high rates. I think what you meant is that those three, the market was expecting those three things: high tariffs, high growth in the US, and high US interest rates, all three of which were bullish the US dollar. And that case has somewhat deteriorated over the course of the year. Is that what you were saying?
Yes. And I think the
Yeah.
key point there is that the dollar, from a valuation perspective, is at a point where it wasn't enough for one of those things to exist. Kind of all three needed to exist. Why I think this move lower is somewhat durable is because the starting point really gives us a nice runway for, I would say, a more normalized level in the effective dollar exchange rate.
And when you say the US dollar is overvalued, are you referring to purchase power parity? Basically, everything in the rest of the world is cheaper than it is in the US? Or are you referring to it's expensive relative to, I guess, what's priced into the forward markets and rates?
So I think it's a confluence of things. I think that there is sort of this PPP element, but I think we've kind of been in a, what I would say, structurally imbalanced global economy that hasn't been fully healed. Something that we've seen is that, well, so far Europe has sort of answered that call, which has explained why the euro gains this year have been, I would say, outsized vis-a-vis those of the yen, vis-a-vis those of the Chinese renminbi, because Europe is starting to address sort of that structural imbalance. PPP has been sort of reflective of China still wants to run, I would say, a heavily mercantilist economy focused on exports as being sort of the main channel of incremental GDP growth. Japan has, to say it lightly, has continuously dragged its feet in terms of monetary policy normalization, which has kept the yen very depressed in terms of its um, valuation level. So I think that there are a lot of big stories that would argue why the dollar over time will sort of come to more normal levels of valuation, even if it's not going to become weak. I don't really see the case for it to become outright weak, but I think looking at it in terms of what those drivers are, I think that there has definitely been an interest rate differential story that started this year that I think is going to continue, where interest rates, especially in the front end of the US market, have come down in yield pretty considerably since sort of the beginning of the year, where things like one-year US rates have come down between 70 and 80 basis points, while places like Europe, we really haven't done much this year, so that spread has come in quite a lot. I think this is something we've seen also versus Japan. And I think that story where the US kind of has this meaningful real yield advantage versus the rest of the world, especially in front end rates, I think we've lost that vector in terms of being dollar supportive. I've become very pro showing people, ask people if you had to guess where 2 year real rates in Europe are versus 2 year real rates in the US, given that there's still a 200 basis point differential in terms of the policy rate, it's pretty close to zero.
Hmm.
Um, and that's because inflation in the U.S. has gone up this year, and our expected policy rate has come down. Well, in Europe, the expected policy rate has gone up maybe a little bit, but inflation has continued to come down, at least in a forward sense. So I think that a key pillar for the dollar, I would say, going back really, if we think about this cycle, even bigger picture than the last few years, but really since 2014, 15, really the last decade, has been there's been a considerable yield advantage in being in the US. And, I think that, it's not to say that US rates are going to trade, inside a lot of these other markets. I don't see that. But I think, for a country that requires a lot of incremental capital flow to fund, a pretty material twin deficit between the trade balance and the budget deficit, I think it's just not a lot of cushion. And I think that that can sort of be the beginning of, why the dollar should continue to fall.
And why was it in the aftermath of the great financial crisis that the US dollar was so strong despite the very large fiscal deficits? What has changed since then of the US dollar bull market from, let's say, 2008 to 2020? What's different now?
I would say probably a key point in the GFC recovery, but also in the COVID recovery, has been a clear outperformance of US growth vis-a-vis the rest of the world. Part of that has been that the US is a much more insulated economy versus, let's say, Europe, Japan, or a lot of the other major developed economies. And we've seen China slow down, especially over the last decade. And China being the largest trading partner for a lot of the world, and a lot of the world still gets close to a third of its GDP from exports. So I think that's one reason. We will talk about the Fed paper that you mentioned before, but I've argued that there was a pro-cyclical nature to that kind of exacerbated things. But I think the other part of it, especially in terms of the fiscal deficit, is that the US has been able to attract an enormous amount of capital. And I think that's really come from two places. One, it's had a relative interest rate advantage, which is significant as it's the deepest pool of capital markets is US Treasuries. And we've had basically a rolling tech bull market with companies that have been really able to absorb a lot of rest of world savings. The chart that really encapsulates this to me is that from 2017 until pretty much this year, the US net international investment position has basically tripled in the negative. And I think that has really insulated the market from what are not great external account fundamentals from any traditional measure. The US runs a pretty material current account deficit, but the residual of capital inflows has just been so big. I think it's dwarfed a lot of the traditional fundamentals. Kind of, we think of the drive exchange rates, and I think the reason has been a combination of relatively high interest rates and very deep capital markets that have offered a narrative that has pulled in a lot of foreign investment. And I think, a big point in all of this, especially as we think about what's going on today, is that these two things have fed off each other because interest rates in the US have been considerably higher than the rest of the world. To have US exposure, and if you wanted to hedge your FX exposure to your US risk asset or safe asset exposure, hedging became a considerable cost because you were funding in the gap between your domestic policy rate, let's say you're Korea, let's say you're Taiwan, let's say you're Japan, which was close to zero, and you're having to pay the US policy rate, which has been closer to 4. So, that has really incentivized a lot of this flow to come in unhedged. And now that thinking really changed around Liberation Day and the April tariffs, et cetera. But I think that that kind of combination has really fueled a massive amount of inflows into the US.
All right, so let's set the U.S. equity market aside. The U.S. has attracted a ton amount of capital into stocks and bonds. The stock story, I get. There isn't an Nvidia in Europe. There isn't a Visa in Europe. A lot of people have fears that China is going to just eliminate all equity. So I understand the equity story, but let's stick to bonds. Why do reserve managers around the world invest so much in US treasuries? Is it just the fact that it's the only game in town and that if you have a billion or $300 billion, you just can't invest that in the Mexican peso market? And then also that point of hedging. Let's go to the most extreme example just to make it clear is Japan. Before the Japan marginally started to hike interest rates, you'd invest in the US treasury market and you'd want to hedge it. But if you bought a Japanese insurance company bought a 10-year treasury note, it would hedge that on the short-term basis, the
Mm-hmm.
90-day, 30-day something, and they'd have to pay such a high interest rate to do that it wouldn't be attractive. And now you're saying that that's changed.
On the last point, I would say in terms of the hedging, it's not to say it's changed yet because a lot of this, as you said, is done very short term, right? So, even if the market thinks in, March of 2027 that Fed funds rates are going to be, at 295, they're still at 4% today. So, a lot of this hedging takes place in 3-month rolling windows. So that's much more connected to the actual policy rate than sort of where the forward market is. This is something that I think will accrue over time, right? But I think markets will become forward looking in nature. And I think that a really good example in terms of thinking about this and how this dynamic sort of came to be is the Taiwan life insurance industry has become a very big buyer of U.S. corporate bonds. So this has been the case really for the last 10 years. The Taiwan life insurance industry, just for perspective, is around the same size as Taiwan domestic GDP, which means there is no ability for them to invest locally. Principally, there has to be a lot of spillover. The US, in terms of its depth, liquidity, and in terms of return, has been able to offer a very good place for them to park the money. For them, if let's say 5-year IG is sort of their go to, if they
5-year
were
investment grade corporate bonds, yeah.
exactly a 5-year investment grade corporate bond is sort of their go to, let's say that yields something with a 5 handle. If they were to hedge that back into Taiwan dollars using 3-month cross currency basis swaps, the effective yield would go from 5 to around 2. Basically, they lose all their return. They may as well buy, not they would overpower the market, but local belly rates in Taiwan yield around the same thing. So this has forced them to make a very cognizant decision of, let's just own it outright. And I think that in terms of thinking about what's going to change or what is changing, I think we've noted the story that interest rate differentials coming down will mechanically allow for more hedging ability. And I think the second thing that's important is that the April episode of this year showed is that your risk assets can go down and your dollar exposure can go down at the same time. And this was not the way things were thought of sort of going into that episode, where people assume that, especially with, more risk currency betas, think of the Norwegian pension fund, sovereign wealth fund, sorry, where their thought, and it was quite rightly their thought was that, well, if the NASDAQ goes down, then the Norwegian krona goes down and that offsets some of our loss. So, what happened in April was that, risk assets went down, credit went down, and the dollar went down with it. So it really compounded those losses. I think those two things entering the fold are a very big difference to where we were sort of over the last couple of years, where the thought was not only is the US the only game in town in terms of investment ability across the risk asset spectrum, right? From Taiwanese lifers wanting a 5-year investment grade credit in the US to Norwegian sovereign wealth fund wanting NVIDIA. The market offered the depth to do it, it offered the returns to do it. It offered this kind of innate hedge by having the FX exposure serve as a buffer, not a headwind. And those things at the margin, I think, are changing. And you know, from where we are in terms of how big these flows have been over the last 7 years, kind of noting what we said before, where money into U.S. assets, which was already at a high level, tripled in 7 years. That these are like very, very meaningful shifts. And it's not to say that, you know, the Norwegian Sovereign Wealth Fund or the Taiwanese lifers or the Korean pension fund, like all of these actors are still going to want US assets. The question is there going to be more going in than there has been? Because the rate of change is all that matters in our business. And, I think that there's a possibility that in an absolute sense, the answer is no. And there's a very high likelihood that in the FX sense, where, if you don't, even if you don't want to reduce your asset exposure, you do want to reduce your FX exposure. And that choice is going to become available to you as the Fed's, sort of normalizes rates.
So as the Federal Reserve is cutting interest rates, it's reducing the cost of foreign entities who live in low interest rate worlds, Japan, China, lots of Europe, to hedge their FX exposure to the dollar. So is what weakens the dollar more? Like if a Japanese pension fund buys the US dollar, buys a US Treasury bond, I guess what's the basis or what's the effect? You know, what strengthens or impacts the dollar level more, like buying US a 10-year bond, or is it the hedging market? Like, is it just the hedging market and just the short-term rate that affects the spot dollar rate? You know what I'm saying?
I think you have to look at it a bit more holistically. Treasuries have become a weird example because, at the margin, foreigners haven't really increased their exposure to treasuries. Really, the marginal increase in exposure has been in risk assets. Now, it's just, counting investment grade credit as a risk asset. That's really been the focus, which I think is amplified why the dollar trades more sensitive to risk assets. As we've seen this year, there's been much more of a positive correlation between the dollar and risk assets than what we're used to. Usually, the dollar has a lot more safe haven characteristics, and with risk on, it's sort of dollar lower. But as we've seen this year, it's been definitely showing that it's more risk asset sensitive, and I think that's the reason why. And I think the question going forward is it's less of the jump risk is less now, because I think, as we've come through the April episode, anything that was like an emergency was done, right? We saw record flows pretty much post the Liberation Day moves. And that was sort of, I would say reserve managers, big pools of foreign capital basically doing what they can to sort of get their FX exposure back on side.
Record flows out of the U.S. either by selling assets or by just hedging and
Both.
selling
Both.
dollars in the hedging market.
Anything you could do was done. Now as we go forward, I think it's going to be a lot more strategic, and it's going to be a lot slower moving because these pools of capital, they don't move like hedge funds. They're methodical. There's a lot of committees, and they think more in terms of years, not in terms of weeks. And I think that the question that's been asked of the market really since the risk assets stabilized in May is because the gap in hedge ratios, or the gap in terms of how much cost to sort of hedge your US risk asset exposure has become, the question posed was, do you want to sell risk assets to right size your dollar FX exposure? And I think the answer broadly has been no. And quite rightly, we're 30% off the lows in terms of US equities, investment grade credit, high yield credit, risk assets pretty
What
much.
do you mean 30% off the 30% off the lows of April 8th or something? Gone
Yeah,
up.
yeah,
Yeah, sorry.
yeah. 30% off the lows, and just using SPOOs or NASDAQ. And there's definitely this, especially as we have this narrative dangled over where there's this investable theme, namely AI. People don't, if the only way to right size your FX exposure when hedge ratios or when hedging is expensive is to sell an asset, well, that not very exciting right now, right? Because no one wants to miss out what's going on in the US, especially in light of what's going on in AI. As we kind of move forward, I don't think we've lost this desire where for the last few years, People didn't think of their FX exposure as a liability, and they do now. And I don't think that's changing. And the question is just, when do the economics make more sense? And I think the economics will make more sense as interest rates in the US continue to come down. And I think that there will be a little bit of a pro-cyclical element to this as well. Whereas, if risk assets were to weaken, or if the US economy was to incrementally get weaker from where it is, these things could kind of accelerate again. But I think at a minimum, this is sort of the path we're on, where even that it's not this, there's definitely no capital flight from the US. But, you know, given the starting point, if structurally, hedge ratios are going up, and structurally the amount of actual dollars coming to the system are less, that's just very meaningful for currencies. And it's very meaningful for currencies that are using the US dollar at a historically rich level.
So there's no outflow of the US dollar anymore, maybe a handful of days during April after Liberation Day, but there's no, gross outflow, but the net non-US savings dollar or savings unit of savings is being deployed slightly less into the US market on an unhedged basis. So is the scenario that you're seeing going forward a world where in dollars the US stock market could do well? It's not as if Japan and Norway are dumping the S&P and Nvidia. It's just that on the margin, when they're buying S&P and Nvidia, they're just selling dollars and aka hedging a little bit more. So bullish US market, but bearish US dollar against the euro and yen and stuff.
Yeah, exactly. The way I see it now, and this is very key to, I would say, more my macro framework in general, a very like distributional approach. And if the distribution to me is that from an FX perspective, the incremental inflow is going to be on net a bit more hedged than it's been historically. That weakens the positive link that risk assets have given the US dollar. And I think that if US risk assets were to weaken, that would damage the flow side, especially given there's a lot of legacy gains in the system. I think that's sort of the disposition, where if risk assets go up, I don't know how much more incrementally positive that is the dollar, as long as the Fed is cutting. And if risk assets go down, I think that's incrementally negative to the dollar, given just how big the gross exposure is. So that sort of tilt is kind of why I still favor that the direction of travel in the dollar is lower.
Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview. And how does your views on your paper you co-authored, the US dollar Imperial Circle, just sketch that out, and how does that apply to the dollar dynamics this year that we've been talking about?
The Imperial Circle is really based off of, sort of, I would say, the decade of the 2010s. And the Imperial Circle was basically, me and my co-authors called this basically this pro-cyclical feedback loop between the US economy, US risk assets, and the divergence between the US and rest of the world. And the way it would work in principle is that the US in the 2010s was having this endogenous recovery while the rest of the world was kind of stuck. This led to, inflows into the US, helped the US economy, and then the dollar, because global trade is priced in dollars, trade is, very sensitive to the level of the dollar would go up, which would weaken global trade beta. And as global trade beta weakened, the US was innately less exposed to that. And that would further the divergence between the US rest of the world. So the US was like sucking in capital, which was improving US growth, which was weakening foreign growth because, via the dollar exchange rate, which was weakening global trade. Most of the world is much more exposed to global trade than the US is. And this was creating this pro-cyclical feedback loop that was basically, shooting the dollar higher if you look at it over the, basically 2014 until, now. I think, what changed post COVID, I think, there's two things to me that are most notable. Not that I think this framework is still relevant. I think there's just, a couple of things have changed on the margin. One is that, US and rest of world fiscal policy has become much more proactive. So, I think that's weakened a lot of relationships. We used to come in the morning and look at what was the Chinese credit data, because the Chinese credit data led German PMIs and Australian PMIs, and we had, I think that I forgot who had this chart, but if you charted like Chinese PPI versus the Aussie dollar, was like a great, and a lot of these things I think changed post COVID because fiscal policy became a lot more endogenous, and countries had their own responses, and trade then implicitly became a weaker part of the sort of growth composition, even if for a lot of these countries they're still quite export exposed. So I think that is something principally that I've sort of been focused on post COVID, is that there's much more endogenous variables going on as countries' fiscal policy has become much more proactive. That to me, I think, probably the most principal change, and that sort of weakens the dollar amplification of how much global trade will negatively impact foreign economies.
Why does a stronger dollar hurt foreign exports? Isn't a stronger dollar supposed to hurt US exports to foreign countries? Is if the US dollar strengthens, that's great for China, that's great for Taiwan, great for Vietnam, right? Because everything is more expensive in dollar terms. So as a dollar importer, let's buy everything from Vietnam, right?
So from a endogenous textbook perspective, that would be true. Empirically, what we've seen is that the dollar has basically been sort of the global lubricant of the trading system. And the reason that is because trade is settled in dollars. Supply chains have become much more credit intensive, which requires financing, which has been in dollars. Um, and and commodity prices have become a lot more important to sort of export markets, which has also fed into this. So what we've kind of seen is that global trade and global trade beta has just become much more, I would say, negatively correlated with the dollar, whereas the dollar weakens, global trade beta has done better, and as the dollar strengthens, it's done worse. And I think it's sort of it's a lot more of the second derivative variable, because if you look at all these countries, China has been doing it on purpose. All of them would like and do like a weak exchange rate versus the U.S. because the U.S. has become the principal importer. But if you look at it for the rest of the world, the problem with that is that China is really the principal trading partner for most of every other country. And if the RMB is weak, that means that Chinese demand for your goods is going down. And pretty much for everyone outside of China, the biggest trading partner that you interface with is no longer the US, it's often China. This especially became true for Europe in the 2010s.
And what's going on with the yuan right now?
There's really a twofold element to it. I think that people in the US government, especially in Treasury, would be sympathetic to the idea that China is artificially keeping the currency weak in order to maintain its export advantage. Something that's very obvious to anyone that's been following is that China's trade surplus has exploded post COVID, something I think that you and Brad Setzer were talking about in the last few days. And the currency is weakened. Usually, the equilibrator between an imbalance between export and imports is the currency strengthens to reflect the inflows into the country. But on the flip side is if you think about China in terms of the capital account, as we know, FDI has fallen off a cliff. We know that in a normative world of where the capital account would be open, there's plenty of Chinese who would like to get money out. So, what we're left with is that we basically have two economies in China, where you have sort of the export economy and you have the traditional household sector. And from the export perspective, the currency should be a lot stronger. And from the household sector, maybe it should be even weaker, especially as you could argue that China's underdone it in terms of domestic stimulus.
You're saying that because on the export channel, obviously Chinese exports are ridiculously competitive, and therefore the yuan should strengthened to make them slightly less competitive in an equilibrium. And then on the household sector, you're saying there are a lot of Chinese citizens, particularly wealthy Chinese citizens, who, despite the fact that the yuan is extremely undervalued, they actually want to get out of the yuan, presumably because of political reasons. They just want a little diversification. They want to buy a house in Toronto, that kind of thing, right?
There's also a very fair argument, rest of world assets have outperformed Chinese assets over the last decade, pretty considerably so. If you look at it, the US versus China. And there's an interest rate advantage in the rest of the world versus China, right? Chinese interest rates have continued to come down as we've kind of had a big reset in terms of the global level of interest rates. So I think there's a lot of reasons why in a world of a more normalized capital account, given the level of where Chinese household savings are, I mean, as we know, the savings rate in China is absurdly high. I think some have it. I don't want to misquote Brad, but I think he has it as high as like 40%. And you can make an incredible argument that a lot of that would be exported. So I think that we're definitely reaching a tipping point. In terms of how much can the world really tolerate? China running $1 trillion trades. I mean, these are really big numbers. So I think that is a big part of it, but it's also become clear from years of insufficient fiscal to borderline insufficient monetary response to domestic conditions that they plan to export their way out of this. Trade war be damned. We continue to really take the view that they're the most competitive manufacturing sector, and that's moving up the value chain. And it's went from low end, and now it's in cars, and it's going to be in chips, and it's going to be in. They seem to have this bigger vision of being just extremely competitive, and I think that this is sort of the backdrop they want. The question is it sustainable in terms of the rest of world politics? That would be a question, but at least as of right now, nothing seems to be changing.
And tariffs don't change that because, as Brad Setzer said, the U.S. imports have not changed that much. It's just that the composition has changed. So we're importing less from China and more from Vietnam and Southeast Asia. But guess what? A lot of those Southeast Asian imports are actually from China.
Right. So, and this I think you can really tell, especially over the weekend. We've kind of returned to the jawboning. I think they called it the Geneva mechanism, which was supposed to create an off ramp for any future trade disputes between the U.S. and China. That seemingly has been breached over the last few days. I think you can see in the Chinese disposition they don't act like a country that their whole economy is based off exporting to the U.S. And if I would guess, if you broke it down, as Brad said, it's really hard to run $1 trillion trade surplus and the U.S. not be a very big end demand market. Just 1+1 doesn't equal 2 if that's not the case.
Directly or indirectly.
Yeah, exactly. So it seems to me, it will be very interesting to see what are, the potential, next points in sort of this, rare earths. It all seems more emblematic of a bigger divide at this point. And I think the question is this become the US and world versus China as opposed to, each country has its own mini trade war that gets resolved with a new framework plus a bit of investment. But I think that is a potential change in terms of the backdrop is if the US can build a consensus against what it feels is, I think a lot of countries feel is an unstable equilibrium.
And how are you thinking about interest rates? So the next two meetings for the Federal Reserve, the market is pricing it's virtual certainty that we get one cut or maybe multiple, but probably just one cut. What are your thoughts on that, as well as the next 2 years of short-term interest rate futures market with regards to the twin threats of inflation and a weakening labor market or recession, especially, Jon, given the fact that we are kind of flying blind here, given that we haven't had data because of the U.S. government shutdown for multiple weeks?
Right. No, it's an interesting time, and so I think we're at I think we're at an interesting time in terms of U.S. rates. I think that I kind of look at it. There's two main things going on. Two main things I'm sort of been flagging to clients as sort of principal drivers in terms of not only the next two meetings of the year, but front end rates in the U.S. going forward. And I think number one factor is the current state of the labor market. It's unclear if it's weak or just weakening, but we've had a pretty sizable reduction in the level of job creation in the U.S. what seems to be over a year now. Now, there's the argument that the supply side has shrank pretty considerably, especially as the new Trump policies have taken place in terms of immigration. But I think, as people like Governor Waller have been pretty clear that private sector job growth over the last few months has been zero to negative, and I have a hard time believing that the break-even rate in terms of the U.S. labor market is that, even if it's considerably lower than what it's been. I think the Dallas Fed argued in a recent blog that was around 30,000 a month. So I think the starting point for me in terms of rates is that the labor market is softening. We don't really know sort of the degree that it's happening in, but the labor market is softening, and it's coming from a place where policy is restrictive. So, that disposition to me is always going to bias towards more rate cuts, because I think you have to think about it in terms of what's sort of the bigger mistake, right? That's oftentimes how policymaker approach these problems. If the Fed cuts a couple more times, it gets closer to neutral, and it turns out some of the more recent growth readings have been a better reflection of the economy than the last few labor market readings, and the labor market is maybe bottoming. That cost won't be so dramatic in the world where policy, by most estimates, is still around 100 basis points restrictive. However, if the labor market is turning into something more nefarious, usually when we get some of these flashpoints, whether it's the level of payroll growth, the level of the hiring rate, some of these things that suggest that we could be handing off where low hiring actually turns into higher unemployment, which is not the handoff we've seen yet. That would require a much more meaningful monetary policy response. And if they're doing it from 100 basis points restrictive, especially in a time when they're really under the gun in terms of the political ramifications, I think that'll be hard adjustment and one that would probably need to be quite swift. And I think that something I've been stressing to my clients is that as long as the inflation dynamic, especially vis-a-vis the tariffs, is sort of more understood from a distributional sense, and the labor market doesn't have a mechanism to sort of amplify these price effects, I have a hard time finding that even if the tariff pass-through was to be quite big, which so far it hasn't, that would be more marginal over labor market weakness. So I think that in terms of the economy, still the focus is more on the labor market than on the inflation side, even though there's clearly this big divide on the committee, which they should be paying more attention to. So that, I think, is first thing. I think second thing, and this is going to become ever more relevant as we get closer to when the administration makes the decision, but Chair Powell is going to be done in Q2 of next year. And the administration has not been shy in saying they want someone who's a low rate guy. And I think that, that is, had this twofold impact where, one, the administration has basically held over the market this idea that the next guy is going to want rates lower, which in terms of the market's ability to price rates higher, let's say on the back of good growth data or good risk asset performance or what have you, that's been muted because the markets had to sit there and say there's a possibility that, even if the growth data isn't so weak, that the new guy will just want to get rates to a more neutral setting anyway, because that's sort of, what more the administration wants. And then I think second, we have this pretty big gap in terms of, I think we're down to 5 candidates now in terms of the job, and they range from, what I would say very highly credible candidates like Governor Waller to, not less credible, would be seen as more political candidates, take a Kevin Hassett, who, perfectly good economist and has, very orthodox policy background, but that would be seen more as a
He's a Trump guy.
Exactly right. So though that factor is going to become ever more relevant. I think we're thinking about these things in terms of, well, does Lisa Cook go? Does she not go? Is the administration able to form a majority on the Fed? Basically, a la the Supreme Court. And I think these things are important, and I think they'll become more important as we can kind of really imagine who the new guy is. So those are really, I think, the two things that I'm focused on. And it's hard because we moved quite a bit. The market's priced for a decent amount. If you look at where the market is priced for over a year from now, they expect the policy rate to be around 100 basis points lower from where it is today. If I look at these two factors, and assuming these are the two marginal factors, namely unsure if the labor market is just weakening, but it's on net getting worse than where it was, and we have what I would say is a pretty dovish impetus coming from the new selection and maybe the new composition of the Fed. Both of those things, to me, bias front end rates lower. And, at worst, I don't see how you can really have this very dramatic sell off in front end fixed income in that environment until those two things are resolved, which of course they could, and one of them will eventually. But, that's sort of the backdrop where we are today.
And so over the next year, I'm just looking at Fed funds pricing. The market's expecting the Fed funds rate to go from 4.1% to 3.1%. That's from October 2025 to October 2026. From October 2026 to October 2027, it's pricing virtually no cuts. So it's just kind of a flatlining of rates. So are you bullish on that 1 to 2 years out where there haven't been that much Fed cuts being priced at all, unlike the next year where there's lots of cuts priced?
So it's a good question. To be honest, I think that, when we're in these periods where the labor market's weakening, I think that really biases the very front end of the curve. Because, further out, the labor market could be weak. The Fed could cut 150 basis points and then be hiking in 2 years. I don't know. Now the market is assuming that, as you've noted, it's a very flat money market curve after sort of the rich point on the strip,
Mm-hmm.
which is, quite unusual for a market that's like, romancing a considerable amount of cuts, because usually what happens is you sort of have that rich point of the curve and then the market starts to build some hike risk premium for the next part of the cycle. But the market has assumed that the next guy is not really going to be very keen to hike given his boss. So, that explains why we've kind of flatlined to where the rich point is. I think that the way I've been looking at it and writing about this to clients is when you're dealing with labor market risks, you really want to be in the meat of the action. And I think the meat of the action now is, sort of the next 6 months, because I think that's going to be the resolution of, what this labor market story is, especially in the context of, GDP growth that seems to be inflecting higher. Those two things are, definitely, 3% GDP growth, as we're probably going to get in the third quarter, is, quite incompatible with job growth that's negative or zero. So one of those things is going to have to be quote unquote right. I think that the action point now in terms of U.S. fixed income is really at the front end. And the questions for what should the strip look like in 2027, 2028, I think are harder to say, because you can make the argument that economic conditions will improve by then. Certainly, a lot of factors in the equity market are suggesting that. But also, we don't really know. The forward reaction function of the Fed is quite hard in a world where, there is more of a political component, at least ex ante. Now we don't know. Kevin has to come in the seat and may sit down and be totally apolitical. That's very possible, and that will be, traded in of itself. But I think the market now has to discount a strip that stays pretty flat to where the terminal point is. And I don't see that changing this far where the market is until the new guy sits in. I think then we can have this sort of bigger conversation of like what the 2027 curve should look like.
Okay, and I'm just looking at the near-term pricing for January, March, and April, and it seems to me like, in March, for example, the median cut is 3 cuts, even though over the course of 4 meetings. So I guess slightly less than 1 cut a meeting. But I feel like, John, correct me if I'm wrong, to really make money here, I guess it's differences in options and stuff, but like the Fed would have to cut by 50 basis points in a single meeting. Is that right or wrong? And do you think that that's on the table?
So I would say that's mostly right. The floor of policy action has been rising, which means that, assuming things kind of mostly stay the same, the Fed's kind of signaled that they want to do, 2 this year is what the SEP shows, and then 1 or 2 next year. So I think that's kind of like, and they're not assuming this, more market deterioration in the labor market. That assumption, I think, gives you a decent floor, and why I think this pricing will be pretty sticky. And then from there, I think it's you kind of get the optionality on something more nefarious, which again, I don't have any edge in telling you which way the labor market's going to go. Empirically, when labor markets weaken, they weaken cyclically. It's not just sort of this, stop, start, stop, start. But there's no law of nature that suggests that can't happen. So to me, the way I've kind of looked at it is, okay, we have this debate between the growth data and the labor market data. Which one is sort of more suggestive of where we're going? And, to me, if the growth data wins, I'm still going to get a couple cuts where I don't think I'll lose much money. And if the labor market data wins, then I think the Fed is going to have to make another adjustment in terms of their response function. It's going to lead to, I don't know if it'll lead to a 50, but the market will definitely romance 50s, and it could be more than one. Because again, the starting point here is, as you said, is 4% funds rate, and they assume neutral to be 3. And then the question is, if the labor market's not only weakening, but maybe is weak, as some members have started to suggest, does that mean the Fed should be accommodative? I mean, these are sort of the distributional questions that I think will become relevant if the labor market deterioration continues, and why I think there's still, even though there's a decent amount priced, still this asymmetry in the front end.
So you said the labor market showing signs of weakening. There's strong GDP data. One aggregate of that is the Atlanta Fed GDP now is predicting or forecasting a 3.8% real growth for the third quarter. That is just massive. How can it be that the labor market is as weak as it appears to be while GDP looks like it's about to go on a huge heater?
So I don't know. I think it's really the question of the day. I would say, there's two things that are interesting that's going on. Is one is that, there's obviously this, AI capex boom, which is, creating between 1 to 2 percentage points of GDP, a very material number. The other thing is that consumption is clearly normalized at a level closer to trend than sort of the early indications of where things like PDFP were, which were suggesting that consumption was running considerably below trend for the first half of this year. So I think you've had, further into the story in the AI capex boom, and then consumption returning, sort of more closer to trend, which I think, given that growth in the first half of the year was in the ones, some of this is more of a makeup. And then I think the bigger question, though, is in terms of durability of that is, there are not many episodes in history where, when you have a divide between the labor market data and the GDP data, the GDP data is better on a 6 to 12 month forward basis. Now, do I have this great conviction that this is going to be another one of those times? I don't. And it's why I'm increasingly uncomfortable running long fixed income positions in parts of the curve that I think would be very susceptible to that, namely that 2027 strip that we were talking about earlier, because I think it's, much harder for me. It's not really my edge in sort of this divide. It's thinking about it in a distributional perspective. And I think, tying this back to the dollar, because I do think it ties in very importantly, is from the dollar perspective. And I don't think the market's really appreciated this yet. So I think on a go forward basis, it's really interesting. Because of what I've called the new guy risk premium that's being held over the market, there's definitely this asymmetry in front end responses to nominal growth data that's worse versus better, right? And this has been evidence. I have posted charts about this in terms of looking at the City Economic Surprise Index over the summer, where it was going up and front end yields were going down, even before we sort of had these big revisions in the payroll data. And the reason the market had that asymmetry is the market was sitting there saying, well, even if the growth data is better from 4%, the new guy's going to cut. And if the growth data is not
New guy being Jay Powell's replacement
Jay
in the
Powell's
spring of next
replacement.
year.
Exactly. So, the way I'm looking at this now is, if the growth data is right and the labor market data is sort of overstated weakness, and there's too many Fed cuts priced, I'm not sure we have a drastic adjustment to do, because the market will still have to have some negative term premium in the front end to reflect the dispositional bias of the new guy, Jay Powell's replacement, wanting to cut, which means that in a world of a growth upswing, the front end won't be able to fully encapsulate that, which will mean that likely real yields could go down even in a growth upswing, because break evens would be going up.
The much more amateur way of saying that is that the new guy is going to be listening to the President Trump's dovishness and desire for low rates. So even if the data is good, the labor market's not actually that bad, and growth is gangbusters, that Trump is going to have a dovish influence on the Fed.
Right. And it's not to say that they'll sort of, blindly cut, but their bias to cut will still be there. And that will pressure the very front end of the curve, not giving it the full ability to sort of, reflect better nominal growth outcomes. And if it's not able to better reflect nominal growth outcomes, then that's, to me, bearish to currency, not bullish, because one, you're basically allowing the economy to run hot, which will, further exacerbate the trade deficit mismatch between, domestic supply and domestic demand. But also, the real yields won't go up, because the market will price forward inflation higher if the economy is doing better and interest rates are not fully reflecting that. And in the world where the labor market is right and the Fed has to cut a lot more, then that's, I would also argue, um, fairly negative the dollar. So, I think, tying it back to where we started, this dynamic with Chair Powell's replacement and the administration basically hanging over the market this very dovish disposition, I think has not only, interest rate consequences, but a lot of other interesting externalities. And that, thinking about, risk assets as well.
And how does this influence your view on the 5-year, 10-year, 30-year US Treasury market?
For much of this year, my client notes have been running curve steepeners first in Europe and then most recently in the US. I think terminally, we're still, going towards steeper yield curves. I think tactically, there's a lot of cross currents coming up for duration in terms of, you know, we've been in LDP elections in Japan. We've sort of had French political risk in terms of, Macron being able to keep his government together. We've had, two no confidence votes in the last 2 weeks. And we also have a UK budget on November 26th, which is a fairly big event. As we've seen, the duration move has been very global, right? It's not really been one market. It's been sort of this whack-a-mole. So, I think that thinking about things further out, I think it's a little bit more dicey in terms of fixed income. I think that the fiscal narrative that's profligated to where we are now, where budget deficits are quite high and real rates in the back end are quite high, has sort of created this negative feedback loop between fiscal fundamentals and real yields. I haven't seen really enough on the fiscal policy making side to give me that incremental delta to say, okay, this is a change. Because I think that's all the market is looking for is to get the delta going down and not up in terms of fiscal spend. But it really hasn't happened anywhere yet. Now we'll see what the UK brings. We'll see sort of how these LDP elections in Japan. It certainly looked like we were only going to get a further extension of that with the choice of Takaishi, but now there's been coalition dynamics that have kicked in to counter that. So I think we're entering a really interesting time. We're sort of this political backdrop in terms of its fiscal impact as the market prices it in the long end of yield curves is really coming to a head. But when I look at it from here, I think the bias is still for global yield curves to be steeper until we get something I can hold on to in terms of getting that fiscal delta to be towards the improvement side and not towards the deterioration side. I find it hard to play duration as sort of the way, if you had a lower interest rate view.
Earlier, we talked about foreign non-US investors, Europeans, Japanese, investing in the US bond market and then hedging that currency risk back away. I've heard some things about, a popular trade among some macro hedge funds is actually to do the opposite as a US investor, to invest in Japanese long dated bonds and then hedge that risk back into dollars. So you're profiting from the carry of the FX carry because US short-term rates are so much higher than Japanese, and then I guess you're making slightly less on the JGBs than you were in the US Treasury market, but that differential has gone down as JGB 20, 30-year yields have gone way up. And I guess that's really is a reflection of the view that the US Treasury market is overvalued relative to global bonds around the world. What's your view of that trade?
Yeah, so I think that there's two things there. I think there's the relative treasury valuation, especially in light of fiscal fundamentals that are worse than the rest of the world. I mean, if you just look at an outright budget deficit of the US, it's considerably wider than many of the countries we've been discussing. I think in terms of the JGBs trade, which, kind of getting the cross currency swap as a kicker in terms of carry, I think that I don't have a strong view on it. I think that it makes sense. I think the problem I have with a lot of these yield curves, especially at these levels, is I don't feel like I have a valuation anchor. So, kind of giving you an example, I go and meet with clients, especially for much of this year. Question or things they say is, well, this level of real yields will incentivize lifer flow in Japan, or this level of real yields in the US will incentivize pension buying, or this level of real yields in the UK will incentivize whoever. And it hasn't. I mean, if you look at a lot of the auction data, really for much of this year, we're still, demand for duration is low. The question is like, at 270 real yields or 3 real yields or 3% long end JGBs or 3.25 long NJGBs. Like, I don't really, we've blown through so many levels in duration to say that, like, oh, this is the level of real yield or this is the level of outright yield they'll, incentivize buying. So, I don't have a huge knock on that sort of JGBs hedge back into dollars trade, but it's not really my style. And one, because I don't know that I really like the underlying asset. But, bigger picture perspective, I think it's worth noting, and a lot of these things, right? It's in duration, it's in gold, in crypto, in US risk assets. Once you go through levels of that someone assumed to be a valuation barrier, you kind of the distribution re-rates, because then we have to really entertain, like, if this wasn't the right level, maybe 50 basis points, maybe 100 basis points.
That makes a lot of sense. The backdrop for people is that US long duration 10-year, 30-year rates are lower than their peaks, which were in 2024, 2023. That is not the case in the UK. Yields are at a local top seen in many decades, not the case in Japan as well. So global duration in Europe and Japan is still weakening, while in the US it appears maybe to have stabilized. Jon, that is so true what you said about once an asset goes by a level that no one thinks it can go to. Everyone, there'll be tons of buyers once the U.S. 10-year hits 4%. Then things really get unanchored. That is so true. And in the case of gold, I've been bullish gold for a while, but like 2 weeks ago or maybe 1 week ago, I said this move past 4,000, I really think the U.S. government is going to close its shutdown, and then the price of gold is going to dump and have a bad few weeks. And obviously, I was incredibly wrong. So that really is such a great point. Jon, talking about gold and Bitcoin, but really it has been gold making the move. I mean, this move in gold is just ridiculous. It's now at $4,278, up 57% year to date, and pretty much the same over the past year. From its lows in 2022, it's up 134%, 140%. What's going on here? Who is buying the gold? How much of it are things you can tie to macro fundamentals, real interest rates? Is it buying in Asia? Is it in Europe? Is it in the US? Is it central banks, or is it more who have are diamond hands, so to speak, or is it retail participants who maybe are less diamond handed?
There's a few things, and it can't be one thing when sort of the move is this big, right? It's always a few things. One is that front end real rates disposition that I've kind of talked about in the US, where it's very hard for front end real rates in the US to go up if the market doesn't really credibly price that there'll be a symmetrical reaction upwards and downwards in front end rates and nominal growth data. I think that's very influential in terms of gold, as it has a very high historical correlation to front end real rates. Sorry. I would say that there's clearly this bigger debate on the internet, whether it's called debasement or whatever. I don't know what the right terminology is, but there's clearly this preference that's kind of gone to turbocharge this year, for things over currency. If you look at what's worked year to date, if you use that sort of mental model, a lot of things make sense. So I think that's a non-trivial part of this. And the reason doesn't have to be this sort of big de-anchoring in terms of fiat currency. It's just that, central banks, as you noted, big pools of real money capital are being forced to, widen their safe asset pool, either for risk premium or for fiscal concerns or for geopolitical reasons. Lots of reasons why, but gold is a very natural sort of buffer to that. As we've seen, for these sort of pools of capital, their inflow is very drastic relative to the size of the gold market. I think the third thing that is harder to measure, because the Chinese are very opaque, is we really don't know how this Chinese current account surplus is being recycled. We know it's not going into US treasuries. So the question is, naturally, well, where is it really going? And I'd have to assume that some of this is just the reciprocal of the Chinese external account balance blowing out in terms of its strength.
Meaning that China's buying a lot more gold than
Yeah.
it's letting on.
Yeah. Again, I don't have a data point to show you, but I have to assume that that's at least part of this, because one, it's very hard to find what else they would be buying, because as we've kind of said, global fixed income demand, at least just looking at auction data, but more broadly, I mean, you can see it's just, not very strong. Not clear that they would, a lot of this would go into more risk asset exposure. Not to say that any one of these three things are the reason why gold is up what it's up. I don't have that reason, But if I kind of combine these three things, they're pretty powerful forces. And especially for a market vis-a-vis the other markets we've talked about, is relatively small. I wish I could say I've been standing there the whole year pounding the table gold bull, but I haven't. But when I'm looking at it and looking at these variables, I don't think it doesn't make sense.
What do you think about gold going forward?
Well, the way I think about it was kind of top of mind for me in terms of the gold price now is sort of how we were just talking about a lot of duration products and global fixed income is, once valuation barriers are breached, the market tends to go a lot more than you think. Now, does it go to 5,000? I don't know, but that's kind of the way I'm thinking about it at this stage, where it's, once the market, and then 4,000 was kind of seen as that level, right? Like, there's no way we can do 4,000. And, I think the valuation metric that a lot of people use is sort of like using gold as like a market cap basis versus global GDP or global assets. And we're getting to like pretty stretched levels in terms of those, metrics. But I think that a lot of the demand that we've seen so far, at least talking about the anchors the three things I were just saying, none of those were extremely speculative. They were much more structural and much more sticky. So we might only be at the beginning of the speculative side of this.
I mean, yeah,
But
2 weeks ago, I was saying on this very program, I was saying, yeah, this 4,000 level, it's going to dip below it. We're over 25% of the way to $5,000. I mean, this move is just crazy.
yeah, and I would say in terms of the retail or speculative or ETF component to this, it's really only just started, right? I mean, it's
Yeah.
only going back the last month or two that the ETF data is sort of inflected higher in shares outstanding. If you just look at a chart versus 2010, 2011, it seems like it'd have a long way to go, especially if you denominate it in where household balance sheets are today versus where they were then.
Right. And so there's the central bank institutional buying, non-hedge fund buying. Then there's the retail. What about the macro hedge funds? Ray Dalio, a lot of these macro hedge fund managers, when interviewed, they talk about gold, but just how serious or large or positions, how involved in that market are hedge funds? Maybe not overall, but like when there's a huge gold bull market and macro hedge funds tend to like to follow a trend. The trend is quite clear. It's up.
I would say it's definitely, top of mind the last few months for a lot of macro hedge funds. I would say it feels it's a bit underowned relative to, the veracity of the trend. And as you said, macro people sort of have that gold up disposition to begin with. But yeah, I don't, there's definitely been pockets of, where there's been really outsized performance because of big gold positions. But I would say on net, myself included, it's again, not to want to give the impression that I've been pounding the table on gold. I wish I had. But I don't get the sense that there is this huge party in my client base based off everyone's gold positions.
I gotcha. Yeah. That's
Looking for
interesting.
the bigger picture players and more the longer duration types, there's been decent participation. I would say in the more speculative community, it's been less well held, even if it's been heavily trafficked in.
That makes sense. Jon, thanks so much for joining Monetary Matters. Really appreciate it. People can find you on Twitter at jturek18. You don't post that often. You are on LinkedIn, and your website is jstadvisors.com. Thank you, everyone, for listening. A reminder to subscribe to Monetary Matters on Apple Podcasts and Spotify. Please leave a rating and review. It really helps the show. And, of course, subscribe on YouTube as well. Thanks.
Thank you.
Thanks for listening. Looking to check out Fiscal.AI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.AI/MM. Until next time.
Thank you. Just close the door.